Welcome to the Well Off Podcast, where the goal is to motivate, inspire, and share success principles. I'm your host, George Almasri. On this episode, I interviewed Josh Findlay from Build Financial. He's a commercial mortgage broker for the most part, also does some residential, but he did mention to me that most of his business comes from people buying commercial multifamily. So I think you guys are going to enjoy this if you're looking to scale up, or if you're looking for little strategies on how to get into bigger projects, how to come up with creative financing solutions. We talked a lot about ways to buy a property, kind of reduce the down payment required or the initial funds required, and then the strategies to refinance and working on the exit strategy together. We talked about CMHC financing, bridge loans, all sorts of different types of strategies to make your investment as effective and efficient as possible. So I hope you guys will enjoy the content. Make sure to leave us a review on the Apple Podcast platform if you have an iPhone or an iPad or any Apple product. And if you guys want to connect with me to talk about investing in commercial multifamily, go to www.welloff.ca/podcast. There's a bunch of information there. There's my contact info as well. And I look forward to connecting with you. Enjoy the episode. All right, I'm here with Josh Findlay. This is the first appearance on the show. Welcome.
Yeah, thank you very much for having me. Appreciate it.
Yeah, I'd like to start off by asking about your childhood. So you want to tell me about where you grew up?
Sure, yeah. I traveled a bunch when I was a kid. So I born in Kitchener, grew up in a place called Goderich on a farm.
Yeah.
I grew up in rural Ontario and then moved to Toronto after that for university, and then kind of landed in Kitchener, but grew up in small rural Ontario, Canada.
Godrich, what was it like growing up there?
Great. You know, I mean, you don't know what you have until you don't have it anymore. But, you know, the beach, if anyone's ever been, I think it's called Canada's prettiest little town. It's so quaint. It's nice. Mm-hmm. Having the beach every day was great.
Yeah.
Yeah, it was awesome. And you don't get into the same amount or type of trouble on a farm as you do living in the city. So, right. You know, we had a pretty sheltered upbringing. But, you know, got all the fun stuff. You got to drive ATVs and, you know, all that fun stuff.
Yeah, that seems like the thing that most Canadians do when you're not living in Toronto, right? A lot of people have ATVs and like little toys like that and whatnot.
Yeah, it was cool. We had like a volleyball court, you know, a bunch of places to get in trouble in the backyard. But other than that, you couldn't see our neighbors. So my parents weren't ultra concerned about it.
Cool.
Yeah.
Your journey then, you end up coming towards Toronto and then you settle in Kitchener. Tell me about how you became familiar with investing and mortgages and all that. Yeah.
So finished university in Toronto, completely different field of work. I wanted to be a police officer initially. Kind of got into the whole 9 to 5. They told me I had to go through life experience, got a real job. It was kind of soul crushing. It was in sales. I realized I like people, but I had to get doing something else. An opportunity came up where I was able to become somebody's assistant in the mortgage industry. So I assisted in the mortgage industry for about 6 months until I realized like this is a scalable thing. And now, granted, it was like 2019, like the market was insanely hot. So I was like, wow, this is crazy. Like I didn't even know. I would just drive by houses and I assumed the banks just did all the mortgages. I had no idea they were brokers. So got into that, and then my business partner and I, Aaron, we started shooting YouTube content, and then connected with a bunch of realtors, as well as, you know, Matt McKeever at the time and a few people who were in the investment space. And kind of the stars aligned. We realized that investors needed help and we could help them, but there wasn't anybody really doing it in a way like at scale and doing it at a level that most investors needed. So there's a gap in the market, and money was free at the time. It was COVID. Yeah. The market was hot. Everybody was staying at home watching YouTube videos, and we rolled some dice on shooting some content, and it grew into what it is now. So kind of stumbled into the whole real estate investing thing. Didn't grow up with any real wealth or money, but always wanted it. And then we figured out how to teach people how to get it, and then in turn, obviously invested ourselves.
Mm-hmm. Can you tell me a bit about that? Like you said, you rolled the dice on the social media content. Mm-hmm. So did you just invest some money in doing some YouTube videos with Matt McKeever? Is that what happened?
Yeah, it's a funny story. So like it was just at the start of COVID. And a lot of uncertainty, if anybody remembers. And at the time, it was just I had a bunch of referral partners, and the referral partner situation was kind of dying out because obviously COVID was happening. People weren't able to go outside. People were freaking out. And at the same time, Matt and his team had asked us to shoot some content. He said, hey, we've had some mortgage brokers on the channel before, but nobody's ever really stuck with it. Like, do you guys think you'd want to do this? And at the time, nobody was shooting content. So we were like, this is kind of crazy. Like, we're in this guy's kitchen shooting content for YouTube. So I had to ask for a deposit to obviously do it. There was like a decently large deposit at the time. At least it was large for myself at the time. And I didn't have the money, so I had to ask for a loan from a family member to be able to do this. And you can imagine sitting there in front of your family member saying, hey, I need some money to go shoot YouTube videos with this guy with an orange beard. No one's done it before, but I think it's going to work. Mm-hmm. So took that leap of faith and said, you know, what's the worst that could happen? Let's do it. And obviously the first one was terrible. And then it gets better as you go on. You stay consistent with it. But easily the best investment we've ever made. Like, yeah. We're able to have this conversation 10,000 times and connect with everybody. You know, it is a really powerful tool.
Yeah, that's awesome. I know I've seen some of like Matt McKeever's videos that blew up and have like hundreds of thousands of views. So I'm sure if you had something like that, it would help a lot. Were you just then connecting with local people through doing all that? Was it like people from the States, from wherever?
Yeah, so they have the largest real estate investment YouTube channel in the country. It's like 98,000 subscribers now or something like that. So it's all across. It's national. So we were able to connect with everybody right away. It kind of, it's kind of like it was nothing, and then just like vertical took off like a rocket ship. I think the need for it was so great, and people were looking for the answers, and two things come together, a need and a want, and it worked out really well right off the bat.
Awesome. Zero experience then, like no family in real estate, no investing background. You become an assistant to a mortgage broker, mm-hmm. and from there you shoot this content and your business starts to grow. So what happens from there? Do you just work on residential mortgages at that point, or are you going into commercial as well?
Yeah, so what happened was we grew with our clients essentially. So at that time, if anyone's listening to this, you probably know how easy it was to get a mortgage with Scotiabank or with one of the big five banks. They had something called a rental offset. As long as the income half the income covered all the mortgage payment, you could just continue to buy. It was like numbers just worked. So we essentially help people to scale on the residential side, and then obviously that pushed into duplexes, triplexes, fourplexes, and for a long time the numbers worked. All debt servicing worked on the residential side, so we didn't have a need for it. And then us having to consistently shoot content pushed us to learn different things, because we'd be like, oh man, I gotta shoot more content. Mm-hmm. And it was a natural progression. We figured out small commercial financing, which is commercial financing on residential real estate. That helped a gap as interest rates increased. People could still qualify without using their personal income. And then that pushed into multifamily financing, construction financing, and then we inevitably pushed into insured commercial debt. And now we predominantly do commercial mortgages.
Yeah, because you were saying, I think you said about 90% of your business is on the commercial side at this point, right?
Yeah. It's usually purpose-built multifamily real estate, a lot of CMHC, quite a bit of construction, and we're national. So, the ability to be able to help people in different markets, especially when you have different real estate markets right now. So Alberta, for example, we're able to help a hot market, which is it's an advantage. Mm-hmm.
100%. Yeah, a lot of people are talking about Alberta these days, but I know it's not a huge part of your business, but let's talk a little bit about the residential side, because obviously a lot of people are kind of getting stuck with financing. They're not able to refinance properties or purchase right now because the numbers aren't working. So what are you seeing on the residential side, and what can you say about that? Yeah,
it all comes down to qualification. So, when you're looking at the challenges in Canada right now, you're looking at a few things: debt size and the payment on that debt, and income amount. Income isn't increasing at the same level as inflation was increasing over the past few years. So we still have inflated asset prices. We have the cost of debt is expensive, and the income that is needed to be able to service that debt still doesn't make ends meet. We have a massive affordability issue. So right now, the ones who are really transacting are first-time home buyers or people who have been saved up enough money and who've been sitting on the sidelines. They're taking advantage of a lower price point. We're down about 30% from the top. So anybody who has a good solid job, most people in their late 20s, early 30s, they got robbed of buying a property back when COVID hit and asset prices went up, and then they felt like they got robbed as interest rates went up and values went down. Well, the ones who are ready now are still transacting. If you can qualify, date the rate, make money on the buy the house, and then restructure your debt in a few years when rates are lower. But residential real estate investing, it's tough. There are strategies, obviously, when we spoke about it before, but small commercial financing, like if you're looking in secondary markets and you're looking at the duplexes, the triplexes, the fourplexes, there are strategies around purchasing these properties, increasing the efficiencies of them, like the net operating income to be able to get that refinance. You don't need to use your personal income anymore to do it. So there's still guys doing it. It's just not to the speculative scale that we saw previously.
Can you give us an example of a deal you recently saw that makes sense in a secondary market where you were able to get like one of these commercial programs to work on it, for example?
Yeah. I mean, St. Thomas, for example, phenomenal place. It is near a bunch of larger areas or in the middle of larger areas. Same with like Woodstock, for example. You want to find a place that is commutable to a large urban area, somewhere where people have good paying jobs, but the cost per unit is low and rent is still decently high because it's a commuter city. So we'll use Woodstock, for example. Had a client who bought a triplex, and what they did was they were able to get it vacant because, getting these smaller multifamilies, usually a seller is going to sell it. Sometimes they'll give it to you vacant, or you'll be able to get vacancy. They came to me and they said, listen, I want to buy this property. It's $400,000. I think the whole thing needs work. What I'm going to do is I'm going to put $60,000, $70,000 into it. I think it's going to be worth $600,000. How much revenue do I need to generate to be able to make this happen? Because my income right now, I own my own home. I can't refinance, or I can't qualify for both of these, but I still want conventional financing. And right now, a 4 or 5 year term is like 5%. It's like AAA bank financing. So we ran the numbers. Just you reverse engineer it. You determine what the market rent is, and then you deduct your expenses to get your net operating income, and just how much mortgage can the net operating income support, up to 75% of the as complete value. They did the work, refinance the property, and you still get conventional financing. You still get to do the BRRRR. You have a larger equity position. They limit it at 75 instead of 80, but in today's environment, it's not terrible to not be max leverage.
Yeah, for sure. So what, in terms of the down payment required and everything, you still would have to come up with the initial 25%, right, on purchase, and then do you have to come up with the renovation expenses as well? Or is that something you guys have a program for?
Yeah, so most people will find a creative way to get into these types of projects. Like this is a BRRRR project. They needed some love, so they closed on it with like a short-term bridge loan, like a private loan.
Yep.
Because they had vacancy, they knew they could execute pretty quickly. And not CMHC, but the commercial lender it doesn't have like a time period in which you have to wait to refinance, a lot like the big 5 banks. So they knew they could get in with a 6-month term, do the work, get the tenants in there, and refinance decently quickly.
Yep.
So they just used a private loan to get in.
Okay. So that's one example there. Before we started recording, you were also talking about certain people going after side-by-side properties. So let's say you have 2 side-by-side triplexes. Instead of buying them individually, you're getting a blanket across the 2. So if you want to just share a little bit about that.
Yeah, increased densification laws, federally and provincially, are changing the way investors actually qualify for debt and how values change. So it's interesting because, if you understand what classifies a commercial asset, it's 5 units and above. So if you have 2 side-by-side lots and those lots are adjoining, if you had a triplex and a triplex that are adjoining beside each other, that is now considered 6 units, and you can put a commercial loan over both of those properties because they're together. The strategy around this would be, you could either do a BRRRR, you could get these vacant or almost vacant, and then the income that is produced on this property allows you to be able to qualify for CMHC debt if you'd like, for a regular commercial loan if you would like. It takes the borrowing qualification power away from the actual borrower itself and towards more of the actual asset itself. Valuations also change. So when you're looking at a side-by-side triplex, individually, the value of that asset is based off of a direct comparison of the other properties sold around the area. If you have 6 units on 2 lots together, well, the value of those assets is really based off of the net operating income, so a capitalization approach, in addition to obviously direct comparison approach. But most people are trying to attain a higher valuation through combining both of those properties together. And what that does, it allows you to be able to use certain new products like the MLI product or the standard product, and you can take on more leverage if you would like, or if you have a ton of money invested, more leverage than you would normally be able to take with your personal income to be able to access that capital. You can take a 50-year AM if you can qualify. You can maximize the cash flow on them and set it and forget it for a decade. There's a lot of interesting ways in which people are purchasing side-by-sides, or what they're doing is they're buying a double lot, splitting it, and now you can have 2 fourplexes or 2 triplexes, construct another one, refinance it. And the name of the game really is the takeout financing at the back end of these projects. A lot like a regular BRRRR, you still need to qualify for it. It's the most important part. Anybody with a pulse can get into a deal. You got enough down payment and you got a good property and you have a business plan. There's lots of private lenders out there who will give you money for it, but the exit is the single most important part.
Right.
So understanding and using a broker that has access to different types of strategies and capital for these new investment strategies is ultra important. People are making money in this market.
Yeah, for sure. I have a couple questions for you on the side-by-side example.
Sure.
One, what if it's 2 triplexes on the same street instead of being side-by-side? Would that potentially work?
No bueno. No, has to be the lot has to be adjoining.
Okay, so that's something that must have changed recently, because I remember a few years ago I looked into it, and the broker that I was speaking to at the time said that it might be possible if they're on the same street.
So there are lenders out there that will do blanket commercial loans over like a portfolio of assets, but specifically in regards to like CMHC, they need to be adjoined, and in regards to like the change in value on the assets, they need to be together.
Okay, and what if do they have to close on the same day in 2 properties, or is it possible to have one close like on this day and then one close 30 days later, for example?
Yeah, you can close whenever you want. So, you can acquire one and then become buddies with the guy beside you who wants to sell it eventually, acquire that one. What happens with a lot of people is they'll have a triplex and then they'll get to know their neighbors.
Yeah.
And then the neighbors will want to sell one day. And if they sell, well, now you're in an interesting spot where maybe you can add that ADU in the back, or you can, add that addition in an ADU. The fact that the government has changed the requirement to rezone to increase densification is the single largest opportunity as investors I think we have ever had. Like you have developers licking their chops at the thought of cutting red tape and increased densification.
Right.
This is a dream for anybody who's a developer.
Okay, so I meant more if you were initially getting a CMHC insured commercial mortgage and you were closing on the buying the 2 properties but closing on one and then buying the other one after. I would think that wouldn't work. They'd have to close at the same time to qualify for that CMHC loan.
Correct. Yeah, most people don't use CMHC on the acquisition on a strategy like that, just because the idea is once the buildings are fully stabilized, the takeout financing, because it's so rigid and it's so long and you have an insurance premium, and the cost of being able to put that loan together, is decently large for at least the first year. But the idea is once it's fully stabilized, you would use that as a long-term hold.
Sure.
So most people don't use it on the acquisition. They'd use it at the end of the project.
And in that other example you said where you buy one property, let's say you buy a triplex, and then the next door neighbor says, hey, I'm thinking about selling. You have a conventional loan on the triplex, what would you do at that point to absorb that other property into one commercial loan? Would you just apply and then they would, I mean, you'd share how that works?
Sure. I mean, it depends on what your strategy is. Like if you have a triplex and then your neighbor is a duplex, maybe you can easily add another 2 units. You figure out, do you need construction financing? Do you need renovation financing? Like, what do you want to do to this other building first to maximize its efficiency? And then you would refinance the whole thing together into long-term debt. So It really depends on what you want to do. I mean, if it's good to go, you would probably close on it, because CMHC takes like 4 or 5 months to close. You'd probably close on it with either a bridge lender or however you can close on it, and then you would restructure all of it into a loan.
I'm just thinking about a situation where someone might have a bunch of equity in the property that they already own, and they're not able to refinance it because they're not qualifying. Well, if their neighbor comes up for sale, then maybe they can kind of withdraw or take out some of that equity by absorbing the property next door, right?
Yeah, you could use cross collateral. So you could use like a creative private lender who would take the equity from the current house, and they would use that equity as a down payment source in the new house, and they would put a single charge over both properties, so you don't have to use your own capital to be able to make it happen. It's just a short-term cost to be able to bide your time to be able to restructure it all into one new loan.
Yeah. And if we just talk a little bit about that example where there are the 2 vacant triplexes side by side, if you want to get into a CMHC loan right off the bat, and obviously there's MLI Select options where you can go up to 95% loan to value. Would that be a possibility for you to basically put 5% down to acquire these 2 properties?
They would have to be leased up.
Okay.
So like you couldn't have them vacant. You'd have to lease them up.
Right. And you'd have to have leases in place for like about a year before you can bring it to CMHC, right?
That was a rule. It changed recently. So like the actual like baking of like a lease and like having like a stabilized rent roll, they're not as strict with that as they used to be. They changed a handful of rules, a lot. One about the type of capital that you can pay out. One about waiting 2 years after being with an NHA approved lender. The 12-month stabilized rents. A lot of it has reverted back to not needing any of that anymore. Okay. It's just a matter of processing the loans. And my business partner and I, we actually spoke to Pierre Polyev a few weeks ago just about like the inefficiencies with CMHC and the need to increase the ability to be able to process these loans fast, because intrinsically what's happening is that the risk associated with purchasing with CMHC as well as refinancing, it takes 4 or 5 months. If policy rate decisions change, if your current debt, if you're in a purchase and you have to push it, but you're firm, the liability that's taking right now. So the government understands that there are challenges with it right now, but we're hoping that down the road we do have faster processes.
Yeah. You touched on the changes from CMHC. So this was like maybe 3-4 months ago that they introduced these changes, or was it longer than that?
Yeah, I think it was 2 or 3 months ago.
Yeah. And so just to kind of recap what you said, a few months ago there was a rule where if you had like a vendor take back or private financing on a property and you wanted to refinance into a CMHC product, it wasn't allowed because they weren't an approved lender. You had to be on their approved lenders list for 2 years before CMHC would pay out that loan. But you're saying that now that rule has changed, right?
That's correct. Yeah, that was a huge change. It hurt a lot of people. When that rule came into effect a year and a bit ago, it wasn't in effect for very long, but when it was in effect, it hurt a lot of people who were already in projects. If you were to acquire a property with a vendor take back because you're creative and you understand the game, you were then having to bridge for 2 years into, at the time, very expensive bridge debt. You were essentially cash flow neutral, meaning you weren't making any money, and you had a lot of your invested capital stuck in this deal. And then after the 2 years with an NHA approved lender, which there's one that offered the bridge loan, then at that time you could move into CMHC. Now, the challenge with it really is it slowed the market, which, I'm sure that's what CMHC really wanted at the end of the day. But right now, that's not required anymore. You don't need to be with an NHA approved lender. An investor can now purchase creatively with a vendor take back with a private lender and has no issue paying out the debt anymore.
Yeah. And some of the other changes were on the MLI Select program, which I know you've probably covered 1,000 times, but just really quickly, if you just want to share like how the affordability kind of section changed versus how it used to be, and energy efficiency and all that.
Sure, yeah. So there was a loophole with the MLI Select program for quite a while. Essentially what was happening is for a pre-existing building, you could get 100 points by increasing the efficiency of your building by 40% from the benchmark or wherever it was at that point. Every single investor in Ontario was doing that because nobody wanted to really commit to having any units affordable because it affects the value of your property. The net operating income is less, and it's a commitment for 10 years. What CMHC realized was that was the case, so they changed that. So you can now only get a maximum of 50 points by completing the same amount of work. It still costs a significant amount of money to increase the efficiency of that building. And then if you would like to have higher points, you either need to commit to accessibility or affordability. Now, the affordability metric on a pre-existing building, just to get the minimum points, which is 50, is 40%.
40% of the building has to be affordable.
Affordable. And we're going off of 2019 median renter income data right now, which is not reflective of today's market rent situation. Now, that being said, there are some rumors around CMHC updating that data. It's September, October timeframe. They are working on it.
Mm-hmm. Okay. So that's the CMHC MLI Select, more or less just a quick summary of the changes. If we get into the commercial side of things, you said that some of the people that you've been working with have been able to BRRRR their apartment buildings pretty quickly within 12 to 18 months. Mm-hmm. So that's one of kind of the cons of investing in commercial and commercial multifamily. It takes a little bit longer for you to get your money out. Usually the capital required is a little bit higher, but maybe what are some of the strategies that you're seeing for people to be able to recycle their money quickly?
Sure. Yeah. I mean, right now we're in a buyer's market. We don't have a lineup of people sitting on millions of dollars who want to get into multifamily. I think the guys who have the money have been playing the game long enough, and they just have the capital to do it. So when you're looking to make an offer in today's market, you have to be strategic. So most sellers, you're able to negotiate some sort of vacancy. They understand anybody selling in this market has to sell in this market. Nobody wants to sell in this market for one of two reasons. Either you need the money or the capital expenditure required to be able to fix the building that you've owned forever. You just don't want to put it in.
Or you're just sick of being a landlord if you're in your 70s or 80s or whatever, right?
Well, that's the thing is that the people who actually own these assets, they bought them back in the 60s and 70s. They had little to no debt on them. Most of them don't have any debt on them, which is why they can provide a vendor take back. And they basically let them go. You got something that maybe some things were done and taken care of, but a lot of the times the capital expenditure required to bring these things up to where they need to be from a quality perspective to get market rent is significant. So right now they're offloading these assets, which I mean is probably why you're able to get a good deal. There's definitely a strategy around buying one from one of these guys because they're all friends. They all have multiple of them, and most of them are able to provide creative financing on the buy. Mm-hmm. But yeah, essentially for doing a quick BRRRR, buying correctly, and buying in the right area. So unfortunately, I see a lot of people who go and buy in secondary markets, like not like secondary, but like Sudbury, Ontario, for example. Mm-hmm. I'm not knocking on Sudbury for all the investors in Sudbury, but the access to commercial capital has restraints. So if you're looking for really great bridge debt, which is low fees, prime plus 1.75%, that bridge debt doesn't like rural secondary markets. So you're going to have to go with a more expensive option with higher fees. Secondly, you're looking at your exit as well. So like, how are you going to be able to actually execute on doing this project? Most of the time, people who are looking to purchase in these environments, like they're not really thinking about how the capital is going to work for them. They're looking at the best deal from like a cost per unit perspective, where in reality, the type of debt and capital you get on these projects is the most important part. So just buying in the right area and buying above $1 million. So the metric around the loan size, bridge financing, most bridge lenders don't want to do anything under $1 million. CMHC doesn't really, the lenders that facilitate CMHC don't really want to facilitate loans under $1 million either, which can be challenging for somebody who's looking to get into the multifamily space.
Yeah, for sure. Like if somebody who's thinking about doing like a smaller project, like a 6-plex or a 7-plex in one of these secondary markets, you're probably not going to be able to qualify for that loan, right? Through a CMHC insured program.
Not on the buy. Hopefully that you can increase the revenue enough to have the value, at $1.1 million. So you can maximize that equity takeout at around $1 million. Now we deal with lenders that do allow us $900,000, $850,000. The cost of the debt on the insured side definitely increases when you're in a secondary market with a smaller loan size, because the lenders have to buy the bond, and it's an intrinsic cost of buying the bond, so the spread is higher. Buying in a correct market at the right size are the most important variables when you're looking to get into multifamily. A good market will transcend any real estate market. If you have a good property in Waterloo, your property is still going to be a good property in Waterloo if you're in a down market. You can always get financing in a good market, and as capital markets change, they tighten up or they loosen up. You can always get money in a tight market on a good asset in a good area.
Yeah,
I would rather spend a little more money and get less units in a good area than I would spend less money on multiple units in a secondary market that I can't get access to capital. Your access to the capital, whether it's refinancing or acquiring the asset, is probably the single most important variable you should think of when buying a property.
And when it comes to the financing, if you do have a CMHC loan already and you're looking to get a second behind it, like a CMHC second, can you tell us a little bit about that process?
Yes.
And in what situations would that be, feasible and it would make sense to do that?
Yeah, so it's called a pari passu loan. If you already have a CMHC loan, the certificate of insurance has essentially a checkbox on it. So hopefully when you initially got the debt, the underwriter checked off the checkbox to allow for the pari passu in the first place. If you do have that, essentially what they'll do is it's almost like a blend to term. So they will look at what the current debt servicing on the property allows for at today's rates, and they will factor in your current mortgage payment that you currently have with your first, and then they will issue you that second mortgage to the end of the term of your current mortgage that you have with whatever amortization is left. A lot like regular CMHC loans, most lenders, is a cost to facilitate the transaction. Most of them don't want to do anything under $1 million. So
for the second
as well, they see it as another transaction. So you'd want, the asset value is going to need to be a decently large asset value, and you're going to have to force appreciate that net operating income high enough to be able to access that additional $1 million. Usually we don't see it on smaller projects.
Okay. Another thing, kind of a little bit sort of unrelated to this, but VTBs in combination with CMHC loans. Yeah. Let's say you're purchasing a property, you're getting a VTB in second position for, let's say, 20% of the value of the property. And just for the sake of this example, which is not realistic, but let's say the seller agrees to do an interest-free loan for 5 years on the second. How does that play into qualifying for that CMHC first?
Sure. So for any commercial lender in general, what they're going to do is they're going to look at what the building is currently debt servicing at and what your business plan is to increase the net operating income to a high enough level to be able to pay that loan out at the end of the term. So if you had even a 0% VTB, they would want to make sure that at the end of the term, the net operating income on that building is high enough to be able to pay it out. And if you don't have guaranteed vacancy, or you don't have the same amount of money as what the VTB is in your bank account in cash, it's a really hard business plan to be able to tell a lender, hypothetically, I'm going to be able to do this. Most of the time, large VTBs viable in the way in which you discussed. But on the purchase, there are some bridge lenders out there who will allow for a vendor take back up to roughly 85% aggregately with the first and the second. So there are ways on the acquisition to do it, but like a 5-year VTB with long-term debt, it's probably not viable.
Okay. And then how do they look at the DCR in that situation, whether it's CMHC or the other lenders, the bridge loan, let's say? Sure.
They would take a look at both. So they'd take a look at the debt servicing on the first and the debt servicing on the second. If you had unicorn financing at 0% VTB balloon payment at the back end, you could definitely, on a bridge loan, you could sell it, as long as, again, your business plan allowed you to be able to turn over or increase the efficiencies of the building enough to be able to pay out that vendor take back. Many of them are okay with it. They require, obviously, just like, it's a give and take situation when it comes to commercial financing. So if you want higher leverage and you want to be more creative, then you better have the money and experience to back it up. Mm-hmm. Like, if you want to be high leverage and creative and don't have the money or experience to back it up, it becomes a problem. But the more liquidity you have and the more experience you have in being able to execute on these projects, the more flexible these lenders are going to be to allow you to be able to do it.
Right.
The beautiful thing about commercial financing is the qualification is based off of numbers, but the approval is based off of everything. Mm-hmm. Who you are, your ability to execute, how much cash you have available, your total portfolio debt servicing. It's not as much like, oh, it's automatically approved because of debt services. Who you are and the ability to execute in your relationship with these lenders is equally as important.
Yeah. The part about my question that I always get confused about is, from my understanding, that the DCR on the VTB is different from the DCR on the first position loan, right? But how do they look at that in total? Like, is it a 1.1 on the VTB and then 1.2 on the first, generally, the DCR?
If you're a bridge loan, most of the bridge loans want you to be at a 1 DSR. So as long as you're like flat with your expenses, your vendor take back would be, if it did have a carrying cost on it, it would just be added as if it was an expense on the entire debt servicing.
Okay.
So if you had a $20,000 carrying cost on the VTB annually, you would add that in as an expense line from your effective gross income. Yeah. To equate to your net operating income, and then that net operating income would service however much debt you could.
Okay. So as long as you're breaking even, including that second, the servicing the second, then it should be okay to qualify as a bridge loan.
You don't even need to be qualifying. You don't even need to be at 1. I mean, the idea is to be at 1, but if you're under 1, which happens a lot for an underperforming building, you have something called an IR, which is an interest reserve. So on a 12-month term, depending on what your negative debt servicing or what you're underwater on, they may want a 3 or 6 month interest reserve, which essentially means you have to prepay the interest for 6 months upfront. It's called a depleting interest reserve. Yeah. So for the first 6 months, the bank now says, okay, well, you are underwater on this project. Realistically, in 6 months, you should have 4 or 5 units complete and rented out. So the net operating income projected at that time should cover the carrying cost of this debt. Mm-hmm. We're going to make you pay this up front. Yeah. So the advantage of getting a vacant building is awesome. Very little risk, but in the eyes of a lender, most commercial bridge lenders, they would want some sort of IR.
Got it. I know this isn't necessarily the best way to approach things, especially in the market that we're in now, but just out of my own curiosity, what's the best way to get into a purchase with the lowest possible down payment at this time, right? And that involves like creative financing, whatever it takes. I'm just curious to hear your perspective on that.
Yeah, I mean, again, I think liquidity and experience go hand in hand with the creativity that you can have on a deal. Yeah. Right now, I think that there's never been a better time to be able to negotiate with a seller who's selling one of these things. Again, they probably have very little debt on the property. They've owned it for quite some time. They have vested interest in offloading these assets. They are getting older. They want to go retire. They have multiple of them. And from a tax perspective, they need to sell them, but they don't want to sell them all at once. They want to work with somebody who knows what they're doing, who isn't going to throw them around, who's going to just do what they say they're going to do. So,
and someone who's not going to, like, if they are doing a VTB, they don't want somebody who's going to mess it up and then have them go through a power of sale or whatever, right?
Correct.
Yeah.
If you're going to do it directly, if you're going to do it like buying an underperforming building, buying it with a bridge, and then refinancing it into CMHC when the project is complete, I would recommend 12 or 18 month term with a bridge loan. Your prime plus 1.75 in a good market. You're a 1% lender fee, 1% broker fee.
But you're still in it for like probably 20% at that point at least,
You're
right?
75% with the lender.
Yeah.
You can negotiate a 10% VTB with the seller. You're 15% in.
Plus all the other fees
Plus
and
your
whatever closing costs. So you're in it for even over 20% at that point, right?
Or you're in a unicorn situation where somebody gives you 100% VTB, one or the other.
Yeah.
Now, alternatively, you can, if you have a bunch of equity in your property, you can use cross collateralization with a true private lender, not with like a bank.
Yeah.
And what they'll do is they'll take the equity in your other property and they'll use that as a down payment source. So technically you can have 100% finance, no cash out of your pocket. In situations like these where you want to be creative, you want to have guaranteed vacancy on the buy.
Yeah.
You want to mitigate your risk as much as you can. So, if you're buying a 10-plex and 6 of them are vacant and you don't want to put in your own money in, but you have a bunch of equity tied up on another property, yeah, you could find a private lender to use that equity as a down payment source. You can execute. You don't have to turn over any other units. You can just use the liquidity reserves you have, execute, finish a project, and then restructure the debt in, let's say, 6, 8, 10 months, and then go from there. So there's a lot of variables that go into it, but sure, you could go have no money down projects. It's all about risk, vacancy, how much cash you have, what your experience is.
Sure. Any other suggestions aside from, either going private, VTB, or bridge loan? Is there anything else that you're seeing, a combination of things where you can get into something with, a very small amount?
Yeah, there's some clients who are buying just turnkey multifamily projects. You can go out to Alberta, Edmonton, Calgary. You can put 5% down on a brand new multifamily building. You're higher leverage, but you're able to lock into a pretty low Canadian mortgage bond rate at the moment. As long as you're in a good area, you understand what the vacancy looks like historically, you can put very little down and have high cash flowing assets.
Yeah. Yeah, that's one thing that I've heard actually recently of people going to Alberta and just putting 5 or 10% down on something and just holding on to them for the next 5 to 10 years, right?
Yeah, it's not a bad play. I have lots of clients who go out there. You can do the value add. You can just set it and forget it. When I talk to clients, I have 2 different scenarios. I got the wealth creation scenario, which is the forced appreciation in the BRRRR, or I got the wealth preservation. So you got more money than you know what to do with. You just want to put it into a cash flowing asset. 2 very different ways to own multifamily real estate, but both are viable in this market.
Yeah. So in Ontario, it sounds like it's not as doable to go into something with 5 to 10% down. It's a unicorn situation. But if you are exploring outside of the province, then there are more opportunities there. For
sure. Yeah. Low down payment options on multifamily. The idea of having a low down payment option in Ontario just isn't realistic. But Alberta, for sure.
Have you seen it at all in the last couple months?
In Alberta?
No, in Ontario.
Low down payments?
Yeah.
Just the bridge plus VTB, you're maxing out at 85%. With that's the most conventional financing option that you could have with higher leverage.
Okay. How are the commercial rates looking now? So a couple months ago, the 5-year CMB was about 4% from what I remember. Roughly just above 4. Where we, and just for context, we're at the end of August 2024 right now. So for anyone listening, just so you know, what are we looking at these days?
The Canadian mortgage bond on the 5-year this morning was 3.14.
Wow.
Yeah, massive.
That's amazing.
Yeah, we're the lowest we've been in the last 18 months today.
Yeah. Oh man, that sucks for me. I just closed on one a couple months ago, but yeah.
Hindsight's 2020.
Yeah.
There's a big spread on the 10-year right now. I think we're 25 basis points higher in the 10-year than we are on the 5 at the moment.
Okay.
Still, historically, over the last at least 18 months since we've seen the rate increases, this is a great time to be able to lock in your debt.
Yeah. I don't know if you follow like just statistics and just general economic, I guess, the macroeconomic picture and that sort of thing. But do you read about that often and that sort of thing?
Yeah, I love it.
Yeah. So do you want to tell us a little bit about what you're seeing now in terms of important things for real estate investors to know, and then maybe moving forward, what you expect to see?
Sure. Yeah. I mean, realistically, what we're seeing priced in right now is rate cuts. We are expecting to have a rate cut, a 25 basis point rate cut for every policy decision we have over the next 12 to 18 months, which puts us at around 1.8% from prime rate, down from prime rate right now. Realistically, in 2 years from now, we're going to have 5-year fixed in the threes. Insured rates we're expecting already to have in the threes by the end of this year. Our CPI numbers are trending in the right direction. Our dollar is held up decently well in comparison to where we thought our dollar was going to be because we cut early and the United States hasn't. The United States is now following our steps. They're expecting a 25 basis point rate cut in September, with continuing easing as we continue through 2025. I think it's going to be bumpy. If you take a look historically what happens after we cut rates, cutting rates is the equivalent of a defibrillator on our economy. Like, we are stimulating the economy because our heart isn't moving anymore. We're not operating as we should. So it's kind of a weird situation to be in as an investor, because you're cheering because you want lower rates and things are going to get better from an opportunity perspective. But in hindsight, it means our economy isn't going to do very well over the next little bit. And if you take a look at where we're at, we're most likely going to enter an official recession. We've already been in one for a while, but we're going to enter an official recession. It's probably going to last quite some time, 2025. From an opportunity perspective, a lot of people are deploying capital right now. If you understand value versus rate expectations, valuations are down 30% from the top. I think you're going to have some blood in the water from distressed sellers. And if you take a look at the inverse reaction between interest rates and values, if we're expecting massive rate cuts over the next 18 months, there are speculators that are speculating values will increase as affordability meets that cross, right? So the ones with money, I think, are going to continue to transact and find opportunities. The ones that are going to struggle are unfortunately going to struggle. I think we don't have to get into it here, but Canada's going through a whole bunch of challenges right now, and hopefully we can come out of it with some sort of affordability for the average Canadian, but I just don't see it happening.
And as somebody who's constantly looking at people's profiles and their finances, not that obviously you're going to discuss anyone specifically, but are you seeing higher debt levels in general from just people that you're dealing with? Or because I've heard that before from other people, that Canadian debt levels are at an all-time high or whatever. You hear stuff like that. Are you seeing that yourself?
Yeah, for sure. I think that you take a look at the run-up over the last few years on real estate. Everybody took on debt to be able to acquire assets, and over leverage was definitely a thing. It happened. The average Canadian we're definitely seeing more debt. People are still using lines of credits to be able to finish projects, and then the takeout financing of projects isn't able to take out all the capital to support it. So we have more people holding high interest debt.
Yeah.
We're seeing higher debt levels. Unfortunately, it's like a water and oil situation. The ones who don't have any debt are doing really well, but the ones who do have debt, they're doing really bad.
Right. It depends what kind of debt you have. Like, if you're talking about 12 to 15% debt, then that's a little bit tougher, or 20% debt. But, if you have that prime debt, then I think most of those people will probably be okay, but it's always case by case, right?
Yeah. The smaller guys definitely took on more than they could chew. But again, nobody saw what was going to happen. Nobody expected that. You have TIF saying rates are going to be low for a long time. And then we have a record increase in overnight lending rate.
Yeah.
I'm not saying that's an excuse for people over leveraging themselves. I think people forgot what market exposure was. Everybody wanted market exposure, but on the good end, where your property appreciates every single year and you make a ton of money and you're a genius, but everybody forgot what it was like having market exposure in a down market.
Yeah, for sure. But the thing is, this is all short term, right? I mean, in the grand scheme of things, it's a couple years, maybe 2, 3, 4 years of this, and then things will go back to normal. So it's just, when we're in it right now, sometimes it feels like the end of the world. But when you look back a couple years from now, I think most people are going to be okay.
I agree. I think the market's cyclical, and this whole real estate investing, social media situation, like it's new. You know, when it kind of blew up was at the start of COVID, when everybody decided they were going to shoot content, and it kind of, it's like myself, it took off, right? You know, people now have the ability to learn more, but we only knew that market. So I think it's a learning curve for a lot of people. I think that people are going to be more informed. We've never had more data or access to more data than ever. So hopefully this is just a learning curve for, you know, people to continue to make better choices. You know, I think fundamentally investment in real estate isn't going to stop, but the type of investment in real estate in Canada is going to change. Yeah.
Well, I hear this all the time on the podcast that people are starting to explore other markets, but I think there's still lots of opportunities here. I'm sure you're seeing it too, like Ontario, you know, Alberta, whatever. So just to recap in general, we talked a little bit about residential strategies for today. We talked about commercial options and creative financing and that sort of thing. Do you feel like there's anything else that you want to touch on before we end this?
Just the fact that the conventional ways of investing in real estate aren't the same ways that you're going to succeed in tomorrow's market. You know, I think gone are the days of buying single-family homes and duplexes and just being able to acquire them and hold them and they're semi-cash flow positive or neutral. I don't think that we're going to go back to that. So educating yourself, understanding how capital works. So how do I qualify for conventional mortgages without my personal income? How do I increase value in assets that aren't residential real estate? So how do I increase a commercial asset, value of a commercial asset? How do I scale corporate structure, taxes, all things that most retail investors are going to have to understand to be able to continue to purchase real estate in Canada. So we're just seeing a massive push from people listening to content like this and watching our YouTube channel and all those things around educating themselves and understanding what the next step is going to be to be successful in this country.
Awesome. To finish things off, do you want to tell people the best way to reach you and obviously the services that you're providing?
Sure, yeah. I am one of the co-owners of Build Financial. We were the Findlay mortgage team, rebranded. It stands for Buildings, Land, and Development. We specifically focus on helping mid-sized investors and developers purchase, acquire, and scale. My contact information, I'm assuming, will be down below. You can contact me at josh@bldfinancial.ca. You can hit up our website, bldfinancial.ca as well. We work 27 hours a day, 380 days a year. Like, we work all day, every day. So we're always available.
Awesome. Thank you, Josh. I appreciate you doing this, and we'll be in touch.
Yeah, appreciate you. Thank you.
Thanks for listening to this episode. Your support is truly appreciated. And if you can share this with a friend or family member that might benefit from the information, remember, our goal is to motivate and inspire others to take action and to build wealth and to become well off. Enjoy the rest of your day.